Welcome, and thank you so much for joining us today. My name is Loretta Besson, and I am a retirement plan specialist here at Goulden and McCarthy. I would like to welcome you to our Financial Wellness Program series of webinars. I am joined today by Liam Grubb, Vice President and Senior Retirement Plan Specialist at Franklin Templeton Investments, who will cover the presentation on navigating stock market volatility in a coronavirus world. As we are all living with new day-to-day challenges, we want to help put things in historical perspective and provide strategies to help investors as we live through this period of volatility and uncertainty. As a reminder, our team at Goulden and McCarthy is always available to help answer any questions you may have regarding this presentation or your financial plan more broadly. I will provide our contact information again following the presentation. We will not be taking questions at the end of the session, so if there are any follow-up questions, certainly feel free to reach out to our office. And with that, I will turn it over to Liam.
Thank you so much, Loretta. Really appreciate being on the call today. And first and foremost, before I dive in, I hope that everyone dialing in, that you and your families are safe and healthy during these challenging times. As Loretta mentioned, my name is Liam Grubb from Franklin Templeton, and the name of this presentation is Uncharted Waters, and we're going to review how to navigate stock market volatility in this coronavirus world. So with all the recent events and news related to market volatility, individuals have been wondering, how are these events impacting their portfolios? This chart here shows the growth of the S&P 500 index over the past 10 years through March 31st. The S&P, as you may know, measures a stock performance of 500 large companies listed on stock exchanges in the United States. Although investors cannot direct investly into an index, the S&P index is widely regarded and seen by many as the best representation of the U.S. stock market, which is why I'm going to be referencing it throughout this presentation today. The average annual return of the S&P over the last 10 years, as you'll see, through March 31st, which includes the current crisis, has been an impressive 10.53%. And as you see, up until recently, we've been really fortunate to experience a bull market. And some investors who unfortunately may have just started investing recently have never experienced a significant downturn. It's not surprising that currently, in this environment, investor emotions are running high. So here we are today. Let's review how some of these recent shocks are impacting the market. On December 31st, 2019, coronavirus was first reported out of Wuhan, China. By January 20th, other countries, including the US, had confirmed cases. By January 30th, the World Health Organization, which I'll refer to as the WHO from here on out, declared an international public health emergency as cases were being reported outside of China. 3 days later, the first death from coronavirus was reported outside of China. By February 24th, the U.S. stock market plummeted over coronavirus fears after the Dow Jones experienced its worst trading day in over 2 years. By March 11th, the WHO declared COVID-19 an official pandemic, and the Dow Jones Industrial Average entered bear market territory. The following day, the S&P 500 index entered bear market territory after President Trump announced travel bans on most of Europe, which raised the prospect of a worldwide economic slowdown. On March 23rd, the Federal Reserve announced new measures to support the economy. And then on March 25th, the UN issued a $2 billion global humanitarian response plan. And then on March 29th, President Trump announced CDC guidelines will be extended through at least April 30th. And as you know, for the most part, they're still widely in place throughout our country today. So this combination of the coronavirus outbreak coinciding with an unprecedented oil price reduction is unlike anything we've ever seen before. It may be too early to tell exactly how this is going to impact the economy, but we do know that volatility causes investors to act on their emotions. But we also know that learning from lessons in the past can help navigate these uncharted waters. So for today's agenda, we're going to cover the current shocks in a historical perspective. We're going to talk about what's going on in our heads. All right, we're going to explore behavioral biases and describe how emotions affect our decision-making ability, especially when it comes to investments. And then thirdly, we're going to talk about living with market volatility. So let's get started. While most investors know that the market goes through cycles, it's in times like these when markets are stormy that emotions run particularly high. A historical view, however, focusing on relevant research, solid data, and proven strategies can help put these current events into a historical perspective. While the past is certainly not predictive of the future, it does offer us valuable insights and, again, helps us create this historical perspective. So looking at the past, this chart shows the growth of the S&P 500 since 1970. In our opinion, it really illustrates the history of bear and bull markets. Here we can see that a bull market is defined as a 20% decline from a peak. That's a bear market. A bull market starts when the previous contraction has reached its maximum drawdown and continues until another 20% decline or more. So the recent market contraction, by the above definition, ended on March 23rd. However, it's still way too early to tell how long this crisis will last and what kind of recovery might follow. So taking a look at this big picture, can you draw any conclusions? Ask yourself, what are you taking away from this chart? As you can see, bull markets have lasted longer compared to bear markets, and the average gain during a bull market was significantly higher than the average loss during a bear market. Looking at this, we can see that over this period, the last decade, the average going back to 1970, the average bull market rose 396.9% and lasted 7 years and 4 months, while the average bear market fell 42% and only lasted 13 months. The history of bears and bulls tells us that, declines in the market are just part of investing. Okay, it's important to realize that they're inevitable, they happen frequently, but equally important to remember is that they do not last forever. For example, a market correction of -5% or more has historically happened once every 10 months. In fact, the last market correction of -5% was only back in August of 2019, not too long ago. A market correction of -10% or more has historically happened once every 2 years. The last we see December 2018. A market correction of -15% or more happens historically once every 4 years. Again, in December 2018. And then here we are today with a market correction of -20% or more, which is, again, considered by many to be the universal definition of bear market territory. And this happens historically once every 8 years. So as we saw with the previous charts, following each correction, the market does survive, it bounces back, and it usually bounces back significantly. But let's look at markets in the perspective of historical and smaller viral epidemics. These viral epidemics are not new to the markets. And while markets, they do overreact to the news of these events in the short term, they have tended to reward patient investors with long-term investment horizons. For example, in 2003, the SARS epidemic saw 8,000 people infected. It was brought to an end by good hygiene, simple hand washing, and environmental factors such as warming temperatures. It burnt out when enough people became infected to build an immunity to the disease. And we can see that although an immediate decline, the market rebounded in 23 pretty significantly. In 2019, we had the swine flu. In 2014, Ebola in West Africa, and that ended with human intervention when the WHO declared a coordinated international response. We saw countries work together to administer to the sick, and when a second outbreak occurred in 2018, treatments developed from the first outbreak were offered to patients, and as we can see, the market rebounded from that. 2016, we had the Zika crisis. I remember that like it was yesterday with the Olympics. It seems like, it was yesterday. I can't believe that was 4 years ago. But then fast forward to today, in December 2019, when we had the beginning of the COVID-19 pandemic. It's important to know, we just talked about some historical events, but COVID-19 is unprecedented, right? It is different than anything we've ever seen in terms of past epidemics and past global economic crisis, in that it's really caused a global economic disruption, right? This has triggered responses by governments around the globe and It's really severely restricted economic activity and also global travel. So as of this moment today, we still don't know how everything's going to play out. But again, we know that learning from the past and building on those experiences can help us be more comfortable and live through this period of volatility. Let's transition to behavioral finance and look at what's going on in our heads. And an important disclosure, I am not a medical professional, but at the end of the day, I do know, as everyone in my firm knows, we are all emotional beings. And when volatility strikes, many of us, may feel like we're on a roller coaster. But let's take a look at the human brain over here. Here it is, the human brain, which develops since the first day we're born, and ever since human beings started walking on 2 feet. When we make decisions, our frontal cortex processes a lot of information to make a logical and informed decision. And usually we can do this quite well, right? We decide what to eat, what clothes to wear, what kind of toothpaste to buy, the quickest route to work, etc. You know what, Loretta, I apologize, but I believe I might have lost control of this advancing the slides.
Oh, I apologize. Go ahead. Does that work for you now?
Still no.
I'll get it back to you. Give me 1 second. Okay, I apologize. Technical.
No, don't worry.
Okay.
There's our good old frontal cortex I was just talking about. But then there's this little part of the brain that's called the amygdala. It's often referred to as the reflexive brain because it connects stimuli in the world around us to our experiences, right? The amygdala controls our fight or flight responses. So while our frontal cortex gives us the logical responses, our reflexive brain acts on emotions. So to best explain this, let's look at an example. Remember the caveman? I'm sure few of us would like our frontal cortexes to process what 4-inch claws and 9-inch fangs on a saber-toothed tiger could possibly do to us, right? But our amygdalas may help when confronted and help the caveman realize it might be a good time to run away from the saber-toothed tiger. That being said, our amygdala can be overstimulated, and by letting our reflexive brain control our reactions, especially when making financial decisions that are usually data intensive and very stressful, may lead to some undesirable outcomes. So now let's talk about some more behavioral biases, and particularly we're going to focus on 2 that are very common and that you may likely be experiencing today. The first is called anchoring bias. Anchoring is a tendency to focus too heavily on one piece of information when making decisions. Anchors have a powerful hand in our decision-making and can create unrealistic return expectations for investors. So at Franklin Templeton, we commission a lot of surveys and we poll a lot of investors. And recently we did one and we asked, what the average annual portfolio return for participants was over a 5-year period. The median response was 10%. But when we presented that same group with a hypothetical market that was up 20% in any year, no surprise, their return expectations shifted to a median percent of 20%. So the introduction alone of that hypothetical 20% anchor caused investors to completely abandon their thinking, their original beliefs, and expect stronger returns going forward. Later, with those same investors, we presented them with a hypothetical market that was down 20%. We were pretty surprised to find that median return expectations were still positive 3%. All right, showing us that participants surprisingly expected themselves to outperform the market by 23%. Again, unrealistic, caused by anchoring. Now let's see how anchoring can influence the way we feel about our investment plan. Imagine you invested $10,000 in 1989 and set a goal that earns you an 8% average annual return on your portfolio investment. This is what that would have looked like, right? And a pretty smooth ride, obviously, as well. If your account, if this was possible for you, you would have grown your account to a value of $100,627. This is the reality of what the market really looked like, all right? And as you can tell, you ended up at a higher destination, but certainly not a smooth and a much bumpier ride. So after a few years, when the market hits a new high point, it's easy to anchor to a new higher return expectation. And if the market drops, you lose sight, you feel like you might be losing, and you really lose sight of your long-term goal, not realizing you're still on track, okay? So it's really important to keep focused on your long-term strategy and not let anchoring that may come with short-term volatility steer you astray. Next, we're going to talk about a very studied behavioral bias called loss aversion, right? This is another fear-induced behavior that many investors are likely experiencing, especially today. Loss aversion is defined as our preference to avoid losses because the associated pain is much more intense than the reward felt from a gain. There's been numerous studies in academia that show that the pain of a loss can actually be quantified as twice as strong as the reward felt from a gain. All right. As emotional investors, we tend to make decisions to avoid the pain of loss, right? We all inherently display loss aversion. So, for example, looking back at the dot-com bubble when that burst, investors panicked, and we saw they mostly pulled out their money out of the market, and we saw a huge increase of $491 billion moving into cash or money market funds during this period. We saw a similar phenomenon occur during the global financial crisis, only a few years later, but this time investors put $943 billion into cash. So to avoid more losses in today's markets, investors are probably tempted to do the same thing and move to, a place that they perceive as a safe haven asset class now. But what emotional investors may not realize is that this security likely comes at a cost. Here we have a chart of the average money market yields since 2000, and you'll see that, yields bounced between 1% and 4% for the first quarter of 2008. But ever since then, they've been close to zero for the past decade. So you might be surprised to learn that once inflation is factored in, staying invested in these cash money market investments that you consider more secure while you wait out stock market volatility, this probably led to erosion of your purchasing power. Over the last 19 years, average money market account yields on an inflation-adjusted basis were only positive 15% of the time, and these quote-unquote positive yields we see in 2009 and 2015 were largely due to periods of deflation. Next, let's move on and discuss 3 strategies that can help us live with market volatility. First and foremost, arguably the most important, is the concept, especially in this environment, is to stay calm and keep a long-term perspective. As you've seen, some investors, when faced with volatility, act on fear, pull their money out of the market, diverting them from their long-term goals, right? So let's suppose, hypothetically, you had a $10,000 investment into the S&P 500 on December 31st, 1970. Throughout that time period, up until the end of last year, you would have experienced several events over the course of that history that caused significant short-term volatility in the market. But by staying the course, your $10,000 investment would have grown to $1,191,541 for an impressive average annual return of 10.06%. So again, while past performance can certainly not guarantee future results, keeping that long-term perspective can really help keep your eyes on the prize during these times of volatility. However, all that being said, we know that sticking to these fundamentals is a lot easier said than done, right? So we like to say a way for investors to stay calm and not act on emotions, really simply to tune out the noise, right? Simply said, investors should monitor and check their portfolios less often, right? Ask yourself on the phone right now, how often do you currently look at your portfolio? Since this crisis, I'm willing to bet it's been a lot more frequently than you have in the past. So, it's important to keep a note that stock markets rise and fall every single day with many ups and downs throughout each trading day. This may cause anxiety for those who keep their eyes fixed on daily market movements. The more they watch their portfolio, the more they may let their amygdalas, kick in that fight or flight and potentially overreact on emotions and potentially lose more. So suppose you were investing over a 10-year investment horizon, ended March 31st, 2020. Your perception of your portfolio's performance would change depending on the monitoring period, okay? If monitoring on a monthly basis, you would observe a loss 37% of the time. However, looking back on that 10-year time frame, the market's been positive 91% of the time on an annual basis. So as a tip, set yourself reminders for regular portfolio reviews, okay? And you try not to monitor your portfolio on your own in between those set intervals, okay? And ideally, again, as Loretta mentioned, you guys are lucky enough to work with a team like her and her colleagues at Gould & McCarthy. So ideally, working with an advisor, discussing these goals, discussing your time horizon as well, and keeping things in perspective can really, really help you tune out the noise. So next is a very important and studied topic, and it's really the concept of diversification, right? Diversification is a staple investing for the most sophisticated investors to, your typical individuals who may be complete novices at investing, all right? Diversification has been proven to reduce a portfolio's overall volatility and potentially provide a smoother ride through bumpy markets. There's a chart who everyone in the financial industry, I think, is very, very familiar with, but it's because
hands down our favorite chart. hands down our favorite chart. Yeah.
No matter what, it's probably because nothing better illustrates the need for a diversified asset allocation plan than this chart. Taking a look here, you can see which asset classes performed on a year-by-year basis over the last 15 years. The best performing asset class for each calendar year is at the top. And you'll notice right away that, no single asset class has consistently offered the best or even the top 5 best returns year in and year out. For example, let's look at emerging markets. If you invested in 2005, 2006, and/or 2007, you'd be feeling pretty good about your emerging market stock allocation. But what if you had put all your money into emerging market stocks in 2008? Quite a different scenario, right? And I think it's important to highlight that, because it's important to know that attempting to time the market does not make sense, okay? And we'll illustrate this by considering 3 different strategies. Some investors may choose to chase the winners, right? That is, they invest in last year's best performing asset classes. Others may choose to chase the losers, investing in last year's worst performing asset classes. And a third strategy is asset allocation, which relies on diversification and forces investors to invest consistently across several asset classes at a determined proportion each year. So which strategy does everyone think would have performed the best over the 20-year period just ended? Surprise, surprise, but it's an asset allocation with a well-diversified portfolio. In addition to helping reduce overall volatility and improving your chances to earn a more consistent return over time, keeping assets properly allocated, across several asset classes helps avoid the temptation to once again try and time the market, okay? In addition, as markets change, your portfolio may need to evolve, right? Times of volatility, they offer a great opportunity to rebalance, reevaluate, and possibly change your asset mix. So it's important to remember your investment strategy when markets turn south. Review that plan, ideally with an advisor, with Loretta and one of her colleagues, especially when your emotions are running high. Sorry, that extremely dry mouth right there, but something we're very vocal about at Franklin Templeton that we like to say is, and it's really important to stay the course, right? You stay the course by staying invested. Short-term losses obviously trigger anxiety, but letting emotions drive your investment decisions, they can prove costly, right? One key to living with this market volatility, again, and we're really beating this down, but it's focusing on long-term rather than the daily bumps along the way. Staying the course, again, difficult, but it also can provide volatilities. And I think it's a super powerful chart as well. These blue bars represent the largest declines from a peak to a trough that occurred in any given year since 1988. So despite this intra-year volatility, we see that the green bars show the actual calendar year's returns for all those years. And we'll notice that every green bar isn't as bad as the low for that year, okay? So despite all that intra-year volatility, the S&P had positive year-end returns in 25 out of those 32 years. And again, none was as bad as the low for that year. So volatility, while challenging, can represent some of the greatest opportunities to buy. Which brings us to another topic we want to touch on real quick. Hopefully you've heard of it before, but it's called dollar cost averaging. All right, and this is proven to help make more effective portfolio decisions and potentially make it easier for you to cope with volatility. Most people are quick to agree that if you can muster some discipline and make purchases during a volatile market, it can be beneficial, but again, very, very difficult. So simply put, dollar cost averaging is committing a fixed amount of money at regular intervals to an investment program. So looking at an example of a $500 monthly investment. As you can see, you buy more shares when prices are low, and you buy fewer shares when prices are high. So in this example, over this time period here, your share price over this period was $10, okay? However, your average share cost would have only been $9.77, okay? So the result is your average cost of your shares was 23 cents less than the average price over that period. So dollar cost averaging can help you really reduce anxiety about the investment process. And, individuals should really consider their financial ability to continue purchasing through periods, right? You don't have to be a financial expert to know buy low, sell high. That's something I think that everyone's familiar with. Let's now focus on, how jumping in and out of the market can be costly, right? So we know when markets become volatile, a lot of people try to guess when the stocks will hit a bottom, right? No one's got a crystal ball on their desk, though. And again, even the most seasoned financial professionals, I'm willing to guarantee, cannot accurately call a bottom, okay? Many investors are slow to recognize a retreating stock market. Many are also, they fail to see an upward trend in the market until after they've missed the opportunity. And missing these opportunities can take a big bite out of your returns. So looking at the 20-year period ended on March 31st, we can see that staying fully invested would have delivered an average annualized return of 4.85%, okay? Missing just the 10 best days in that last just 10 days alone, the 10 best trading days alone in that 20-year period, your average annual return drops down to 0.86%. How crazy is that? Missing the best 20 days, you're now in negative territory, negative 1.7%. And I think, yes, missing the best 30 days. I mean, and that's a whole month worth of trading. So I think that's a little more, not as surprising, but negative 3.85%. And Loretta and team, I don't know if you guys have heard this one, but another stat I hear frequently and love to share is from a Bank of America survey. Bank of America looked at data going back to 1930, and they found that if a hypothetical portfolio had been fully invested from January 1st, 1930, until March 31st, it would have returned 14,962%. If that same portfolio missed just the 10 best days in each decade, okay, so only 10 days in each decade, the return would have been 90%. Okay, significantly less than staying invested and staying the course. And, again, holding steady during a downturn. It's a pretty cool graphic over here. This chart shows us, again, some of the dangers of jumping in and out of the market. But it illustrates here that the 20 worst trading days and the 20 best trading days of the S&P index over the last 20 years. And surprise, surprise, what do we see here? In many cases, the best trading day immediately follows the worst trading day. So again, I think this does such a great job of illustrating how it's literally impossible to time the market, right? And jumping in and out can be significantly costly. So nearing our conclusion here, a couple of key takeaways. History once again has shown us that while markets react to shocks in the short term, they have tended to reward patient investors over long periods of time. Our emotions affect decision-making ability in times of market volatility. Behavioral biases such as anchoring and loss aversion may lead to some undesirable outcomes, right? But 3 strategies that we talked about to help you live through this market volatility are stay calm, diversification matters, and lastly, remember your investment strategy. Put things in a long-term perspective. I hope this discussion today has helped make sense of the markets and these behavioral biases. And, again, if you're on this call today, You're lucky that you're in a position that yourself or your company has a relationship with an elite team like Gould and McCarthy. I encourage you to reach out to them, with any questions you have, to discuss your financial plan, right? Because that might be one of the best times in your investing life to really react to these stock market changes and can set you up for the future. If you can set realistic investment expectations today, you may be ready to survive the market's ups and downs with a greater sense of confidence. And with
Liam,
that,
thank you. Yeah, Liam, thank you so much. We appreciate you joining the call today, just putting all this content together for us. A lot of this is information we share with participants during our normal education sessions, but it really is helpful during, as you said, these unprecedented times to bring us back to those fundamentals, reminding us to stay the course, looking back and knowing our time horizon and risk tolerance. And we have noted very positive participant behaviors on our end. So with that, as I said, if there are any questions, if there is anything that we can help you with, certainly feel free to reach out to our office. We are always available for participants. Our contact information is there on the slide. As a reminder, we do record these presentations, all of this content, all that great information on the slide will be available to you. That will be posted on our website. So, with that, we thank you so much for joining us today. We tried to keep this information concise so that you can get great little nuggets, as Liam said, to take away and walk away with some good information and help us feel confident at the end of the day. So again, thank you so much for your time, and certainly feel free to reach out to Gould & McCarthy with any questions. Thank you all. Stay healthy, and we will speak with you soon. Take care.